Welcome to a webinar on 1031 tax-deferred exchanges, how 1031 tax deferral helps real estate investors improve investment returns. I'm your host, Scott Saunders. I'm Senior Vice President of Asset Preservation, Inc., and we are going to talk about a very exciting topic and cover a lot of information about this powerful tax strategy in a very short period of time. 1031 exchanges have become much more popular recently. And a 1031 exchange allows a real estate investor to obtain tax deferral on the sale of any property held for investment purposes. And there are a number of factors that are fueling this upsurge in 1031 activity. First off, we have much higher capital gain taxes, and we have a new tax called a net investment income tax, a 3.8% tax that was added to the code. Taxes today for real estate investors, percentage-wise, are 58% higher than they were just a few years ago. The other factor that is driving this uptick in 1031 activity is that we've got a very strong marketplace. The commercial real estate market has been very robust for many years, and the residential real estate market has been very, very strong as well. We've seen a lot of price appreciation. We've seen rising rents on single-family rentals. We've seen rising rents on all sorts of commercial assets, whether it's office buildings, storage, multifamily. So at the end of the day, real estate investors who have appreciated property are eagerly seeking out ways to reduce their tax burden. And the 1031 exchange plays a powerful strategy in regards to this. 1031 exchanges refer to a part of the tax code, specifically Section 1031, that allows real estate investors to have a significant tax advantage. So a 1031 exchange, which is sometimes referred to as a tax-deferred exchange, a Starker exchange, a 1031, allow any real estate investor holding any property for investment or business purposes to potentially defer all four levels of capital gain taxes that would otherwise be incurred. So it's been in the tax code since 1921. The tax code encourages real estate investors to take their profits and reinvest that into more like-kind property. So it's really a significant tax advantage out there for real estate investors. Now, real estate investors can have a lot of different reasons to do an exchange. Obviously, a big benefit is tax deferral, not having to pay taxes this year and instead pushing that tax liability way into the future. Another advantage is leverage, taking a property where you've got equity and redeploying that with some financing to get a much better rate of return. Some investors use a 1031 exchange to consolidate from a number of smaller properties into one larger property. Others investors use a 1031 exchange for diversification. Maybe that's diversifying into different markets geographically to get some diversification, so not all of the investments are in one market. Or it could be diversifying by the asset class, maybe moving out of single-family rentals and into multifamily or into industrial or office or other asset classes. Certainly one big advantage is for real estate investors that own bare land where they may have a lot of equity but not a lot of cash flow. They can exchange out of that bare land into any income-producing property, so a huge advantage. And then finally, some investors use 1031 exchanges for estate planning, kind of moving around and reallocating their real estate investments while they're alive to maybe set it up in a more advantageous way for their heirs down the road. So there are a lot of different motives, but a 1031 exchange allows an investor to accomplish all of these objectives and much, much more. Now let's look at what real estate investors who don't exchange might be facing in the way of taxes. And as you'll see on the screen, investors that don't exchange have potentially 4 different levels of taxes that they're going to pay. First off, they'll pay taxes on depreciation recapture at a rate of 25%. So anybody that has owned a property for many, many years is going to have a significant component of depreciation. If they don't do an exchange and they do a taxable sale, they're going to have to pay taxes on all that depreciation over the whole time they've owned the property at a rate of 25%. The remaining federal economic gain can be taxed at either 15 or 20%, depending upon the taxable income. Some investors face an additional what's called 3.8% tax on net investment income. And this applies at certain thresholds. It kicks in for single filers over $200,000 of net investment income and $250,000 for married couples filing jointly. And again, this applies to many investors that hold certainly commercial properties, but anybody who's seen significant appreciation. Capital gain is considered a component of net investment income. And then finally, the state tax. And this could be a big factor. State taxes can be as high as 13.3% in California. That's the top tax bracket. So at the end of the day, a real estate investor has to look at all four potential levels of taxes to find out what the total tax hit might be if they don't do an exchange and instead proceed with a taxable sale. And sadly, the end result is many investors see what they perceive to be a lot of their profit eaten up by all four levels of taxes. Now, as a real estate investor, you really have just one of three strategies available to you with your property. One is a hold strategy, so a buy and hold. And many investors do that, and there's nothing wrong with that. In fact, this is a very popular long-term strategy. But I just want to point out that for a real estate investor that is a buy and hold approach, if they're in a part of the marketplace where there's not a lot of job growth, not a lot of economic activity, they might be missing out on significant upside on appreciation and rents. And maybe it makes sense to redeploy the equity from properties in a part of the market that's underperforming into parts of the marketplace that are expected to have long-term growth. So consider that. Second alternative is to sell the property in a taxable sale. Pay all four potential taxes that are owed. Now, the challenge with this is it is very, very difficult to get the same return on investment, what's referred to as ROI, with the after-tax dollars invested outside of real estate as it is to do a 1031 exchange where you have all of the gross equity pre-tax reinvested into another like-kind property. So certainly some investors might opt to do this down the road, sell or do partially deferred exchanges, but it's very difficult for those that are trying to accumulate their asset base and get the best rate of return to get the same rate of return with after-tax dollars outside of real estate as you can with pre-tax dollars still redeployed into other property. Finally, a 1031 exchange is the third alternative. And investors can use this to obtain full tax deferral and pay no capital gain taxes. Some investors offer partial tax deferral. So what I want to point out to you is a 1031 exchange is not an all or nothing proposition. You can certainly take advantage of partial tax deferral and get the benefits of a 1031 exchange and still pay some taxes on what we call boot, some money that's received or reduction in mortgage liabilities. So keep that in mind. Now, I also want to briefly go through the 1031 code, which I shared with you. This has been in the code since 1921. So you can be very confident that this is a very viable, practical strategy that the IRS has been aware of, and it's been a very integral part of the tax code for a long, long time. Here's what the code states. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. Some key takeaways from this. First off, this is non-recognition treatment. You see that in the first line, shall not be recognized. This is not a tax-free exchange. It's a tax-deferred exchange. So the basis of the relinquished property gets rolled into the basis of the replacement property. So that tax liability follows the taxpayer from one property to the next and the next. Now, as long as the real estate investor continues to exchange, they continue to roll over that tax liability over and over and over. So that's why it's such a powerful tax planning strategy. Now, the types of property that can be exchanged are very, very broad, and we'll look at this in just a moment. But it could be a business property for a business, an investment property for investment. It can be an investment property exchanged for a business property or a business property for an investment. So the whole concept of like kind, which we'll look at on the next slide, is very, very broad when we look at real estate. And this is an area where, unfortunately, there's some misconceptions. Some people still think it's got to be an income property exchanged for another income property or bare land for bare land. That is simply not true. Like kind property in the code is any real property, that means real estate, held for productive use in a trade or business or for investment, exchanged for any other property held the same way. So you'll see on the screen in front of you a lot of different images coming in. These are all considered like-kind property. So a real estate investor can exchange out of a single-family rental, or maybe they start with bare land and they go into a single-family rental. And they exchange that single-family rental for 2 more single-family rentals. And then they exchange that for a fourplex, and then for a small apartment building, and then for an office building, and then for an industrial building. All of that is considered like-kind property. So it has to be real estate, what we call real property. Only real estate qualifies. Personal property does not. Now, when we look at the types of property that can be exchanged, there are 2 types that cannot go through a 1031 exchange. The first type of property, real property, is the principal residence. So this is the house that the taxpayer lives in. There is another provision in the code, what's referred to as Section 121, that provides tax exclusion on the sale of a principal residence where somebody has lived in it for 2 out of the past 5 years. But you can't do an exchange out of a residence or into a residence. It has to be held for investment. The other type of real property that is excluded is property that's held primarily for sale. Sometimes that's referred to as dealer property. So if the intent of the real estate investor is to buy a property and immediately turn around and sell it, it's held for sale, not long-term investment, i.e. rental income, if it's in property that can be rented, that type of property is excluded from Section 1031 tax deferral. Cannot do an exchange on it. Other than that, anything that's considered real estate can be exchanged for any other investment real estate. So very, very broad. And in fact, there are many creative alternatives that are out there that are really considered real estate in certain states. Things like water rights, an air right, what's known as a transferable development right. All sorts of things can be considered real property. So something you want to do in any exchange is certainly check with your tax or legal advisor. Have them review your specific transaction, your unique facts and circumstances. Now, what I want to go through is what we call the exchange equation. So as a real estate investor, there really are just 2 simple rules you need to keep in mind if you want to obtain full tax deferral. Number 1, you want to reinvest all of the net exchange proceeds, so what we call the net equity. So that would be after closing costs, after things like the real estate commissions, title company fee, recording fees, etc. Number 2, you want to acquire property with the same or a greater amount of debt. So if you have a $100,000 mortgage paid off on the sale of a relinquished property, you want to have at least $100,000 of mortgage or debt associated with the purchase of replacement property. And that could be on one property or it could be split on multiple properties. So these are the 2 rules for full tax deferral. Reinvest all net exchange proceeds. 2, acquire property with the same or greater amount of debt. Another way to say this is to spend all of the net equity and buy at the same or greater value. You may hear the term boot. Boot is simply defined as non-like-kind properties. So cash boot would be receiving cash proceeds out of the sale. Mortgage boot is a reduction in the mortgage liabilities. So you do pay taxes, or it's potentially taxable on any boot received. Now let's go through some examples to illustrate these concepts, because this is pretty straightforward. If a taxpayer sells a relinquished property worth $900,000, they have debt or mortgage payoff of $300,000, cost of sale, so things like real estate commissions, closing costs of $60,000, it leaves them net equity of $540,000. They're going to purchase a replacement property for $1.2 million. So the mortgage liability goes from $300,000 to $660,000. There is no mortgage boot. They reinvest the entire net equity of $540,000. So this is an example of no boot. The taxpayer receives full tax deferral. Now, I want to show you an example of a partially deferred exchange. Taxpayer goes ahead, sells a property, same numbers, but they buy a replacement property for $700,000. The debt goes from $300,000 to $260,000, so there's $40,000 of what we call mortgage boot. They only reinvest $440,000 cash, so there's $100,000 of cash boot. We add the mortgage boot to the cash boot, and in this example, the total boot is $140,000. And then finally, one last final example that I want to share here is an example where somebody reinvests all of the net equity, but they take on less mortgage. So in this example, the net equity is reinvested, so there's no cash boot. However, the mortgage liability goes from $300,000 down to $260,000, leaving them with $40,000 of mortgage boot. So again, as I mentioned just a few moments ago, be sure to review your individual facts and circumstances with your tax and or legal advisors, something that you want to do in any 1031 exchange. Now let's get to the variations in the mechanics, and you'll see there are a lot of different ways to accomplish a 1031 exchange. What we're going to focus on in this brief presentation is the most common format, what is referred to as a delayed exchange with a qualified intermediary, sometimes referred to as a QI. So this is the most common format. Probably 95 to 97% of all exchanges are delayed exchanges. Let's walk through the steps. At the top, you'll see we have the taxpayer. This is the real estate investor. So you want to obtain tax deferral. You have a property that's held for investment. You list the property. You get it under contract. Now, prior to closing on the contract, you contact what's called a qualified intermediary. The qualified intermediary is going to be assigned into your contract and become the seller of your property. Literally, the qualified intermediary is going to sell your relinquished property and then purchase a replacement property on your behalf. So the contract is assigned to the qualified intermediary. The qualified intermediary steps into the taxpayer's shoes as the seller of their relinquished property. So the property is sold to the buyer. The qualified intermediary instructs the closing officer to directly deed it to the buyer, and the qualified intermediary receives the funds from the sale. So this is the first part of a delayed exchange. Next, the taxpayer looks for a property they want to purchase. They make offers, they get a replacement property under contract, and in the same manner, that contract now is assigned to the qualified intermediary. So the qualified intermediary steps into the shoes as the buyer of the replacement property. So the qualified intermediary is holding money. They purchase the replacement property and then instruct the closing officer to directly deed it to the taxpayer. So if you look at this diagram, just to summarize, the qualified intermediary sells the relinquished property. The qualified intermediary receives the funds and holds the money, subject to certain restrictions. The qualified intermediary purchases the replacement property. The taxpayer is merely giving up title of a relinquished property and receiving title of a replacement property back. Now what I want to do is get into the time frames, because there are some certain rules that you need to follow in a 1031 exchange. They're fairly straightforward, and we're going to kind of go through them. Day zero happens when the property closes, so that begins the delayed exchange process. The taxpayer has, from the closing date up until 45 days, midnight of the 45th day, to identify potential properties. And we'll go through those rules in a moment. So we call this the identification period. They then have an additional 135 days, so a maximum of 180 days, what we call the exchange period. So the taxpayer must acquire property within 180 calendar days or the due date of the tax return, whichever is earlier. So this affects investors selling near the end of the year. Anybody after about the middle of October who files their taxes on April 15th would want to file an extension, complete their exchange within 180 calendar days, and then file their tax return. So to summarize, taxpayer closes on property. They have 45 days to identify the identification period, which ends at midnight of the 45th day, plus another 135 calendar days for a maximum of 180 calendar days, what we call the exchange period, to purchase and close on replacement property. Now, one of the things that this probably brings to mind is, well, how do you identify property? There are three simple rules on how to do this. The first rule is what's known as the three property rule. Under the three property rule, a taxpayer can identify up to three properties of any fair market value. So they're limited on the number of properties to three, but the value can be unlimited. A variation of that, kind of the alternative, is what's known as the 200% rule. Under the 200% rule, a taxpayer can identify an unlimited number of properties. However, the value is limited to no more than 200% of the property sold. So if they sell for $1 million, an unlimited number of properties, but not over 200% of the value. So to summarize these two rules, three property rule, you can identify up to three properties of any fair market value. 200% rule, an unlimited number of properties, but limited on value to no more than 200% of what was sold. And then finally, there's a kind of a catch-all rule called the 95% rule that says if a taxpayer identifies more than three properties and more than 200% of what they sold, they can do that. However, they must close on 95% of the value of the properties identified. So very few people take advantage of this, but there is a mechanism. Taxpayers have to choose either the three property rule, the 200% rule, or the 95% rule. Now you might wonder, well, how do you identify? It's pretty straightforward. It has to be done in writing in a notice that is signed and dated by the taxpayer. You must unambiguously describe the property. So that has to be a specific property. If somebody's going to identify, let's say, a two-bedroom, two-bath condo in Maui, Hawaii, they have to identify a specific unit, unit number 23 or 74. If it's going to be fractional ownership in a larger property, you want to identify the fractional ownership interest. So it has to be unambiguous. This is generally sent to the qualified intermediary by midnight of the 45th day. And I don't have it on a slide, but any property that's been acquired, meaning closed on within 45 days, is considered identified. A few more things to be aware of with this with 1031 exchanges. Whenever you complete an exchange, you'll have to fill out a form called IRS Form 8824, like-kind exchanges. And there's some information the IRS is going to ask for. The date you acquired the property given up, when you sold it in exchange, when you identified property, and when you closed on replacement properties, along with some other information. Finally, a real important aspect of an exchange is making the proper selection of a qualified intermediary. This is the most important choice that a taxpayer will make in an exchange, because they're literally holding your funds from the sale of a property. And so a qualified intermediary sits on significant sums of money. At the federal level, qualified intermediaries are not regulated at all. Now, there are some state-level regulations in a handful of states. That includes states like Colorado, Nevada, Colorado, Oregon, Washington, Connecticut, and Virginia, I believe. But there are no federal rules. So this is something you want to look at. What I want to share with you are some things to ask a qualified intermediary. Does that qualified intermediary, do they offer the backing of a large creditworthy entity? There are qualified intermediaries that are subsidiaries of title insurance companies and of banks. They've got a larger parent company that they are underneath. You certainly want to look at what's the financial rating, what's the balance sheet of that entity. And then you certainly want to look at where are the funds deposited? What banking institution? Is it a large banking institution, or are the funds going into a small community bank? On the next slide, I want to bring up probably the number one thing you want to look at, which is, does that qualified intermediary offer separate and segregated accounts for each 1031 customer? Is there a separate account where the funds are not commingled in with the assets of the qualified intermediary? Very, very important. You want a separate account set up for each taxpayer in each individual exchange. Certainly want to find out, does that qualified intermediary offer a qualified escrow or qualified trust account? You want to explore the fidelity bond coverage that they provide. Finally, in talking about some of these concepts, in a short presentation, we can only cover the basics of a 1031 exchange, but this is a phenomenal opportunity for real estate investors to take their equity and the profits and redeploy them into better and better performing replacement properties to increase your rate of return. It's a tremendous tax strategy. If you want to receive some input on your specific situation, please feel free to contact Asset Preservation, Kayla Franklin or either email KAYLA@apiexchange.com, so Kayla, or call Kayla Franklin at 949-308-9543. So Asset Preservation is one of the oldest and largest qualified intermediaries in the country. We have facilitated in excess of 175,000 1031 exchanges. We want to be a resource to you and to your tax and legal advisors. So we don't replace your CPA or your attorney or your financial advisor, but we act in this very critical role as a qualified intermediary, and we want to be a part of your team. So please give Asset Preservation a call. We hopefully gave you some great information about the exchange process. There certainly are a lot more issues to cover. Please call Kayla Franklin at 949-308-9543 with additional questions and to discuss your specific exchange situation.